There are two types of life insurance policies, term and permanent. Term life is temporary insurance that provides coverage for a specific period of time. Permanent life insurance is a general term for various forms of whole life insurance policies that provide lifetime protection. We'll look at those later, but for now, let's talk about term policies. Term insurance is the simplest, purest form of life insurance. It offers coverage for a set period of time, so it's temporary, maybe for 10, 20, 30 years, or to age 65, for example. Remember, T is for term and temporary. Term insurance is known for providing the greatest amount of coverage at the most affordable premium, compared to other types of insurance. However, there is typically a maximum age limit for coverage, after which it may not be offered or renewed. Term insurance is a type of insurance that offers pure death protection. If the insured dies during the term of the policy, their beneficiary receives the death benefit. However, if the policy is canceled or expires before the insured dies, no money is paid out. Another important thing to remember about term insurance is that it does not have any cash value or other living benefits. That is the main difference between term and permanent life policies. There are three types of term policies: level term, decreasing term, and increasing term. The primary difference between them is how the face amount, or the death benefit, changes during the policy term. The premium, however, remains the same, or level, for the entire policy period in all three types of term coverage. Let's start with the level term insurance, which is the most common type of term insurance. The word level refers to the death benefit, and it means it does not change throughout the life of a policy. The premium will also remain level for the duration of the policy. The second type of term insurance is decreasing term. As the name suggests, the death benefit of these policies decreases annually over the life of the policy. Decreasing term policies are commonly purchased to ensure the payment of a mortgage or other debts, where the amount of coverage decreases as the outstanding loan balance decreases each year. By the end of the policy term, there is no remaining death benefit. If the insured dies before the mortgage or other debt is repaid, the decreasing term policy will pay off the balance. Remember, D is for debt. That's the main purpose of a decreasing term policy. Finally, there is increasing term insurance. And again, the word increasing applies to the death benefit. The amount of the increase may be expressed as a specific amount or as a percentage of the original face amount. Increasing term insurance is usually added as a rider and may provide a refund of premiums or a cost of living increase on top of the original death benefit. So here's the takeaway. There are three types of term policies: level, decreasing, and increasing. And the names describe how the death benefit changes in the policy, whether it remains the same, decreases, or increases. The premium is level in all term policies, so it does not change for the entire policy period. Term insurance provides temporary protection, and it has no cash value and no other living benefits. That's very important to remember for your exam. One of the main benefits of term insurance is low premiums, so it's the most affordable way for someone to get coverage and protect their loved ones should the worst happen. Term insurance may be suitable for young families on a tight budget, for someone who has only a temporary need for insurance, or for someone who has debts that they don't want to pass on to their families. And if life circumstances change, insureds have options to renew their term coverage or convert it to permanent insurance. Most term insurance policies are renewable or convertible, or both. The renewable provision gives the policy owner the right to renew the coverage at the expiration date without evidence of insurability. The most common ways to renew a term policy is for a specified number of years. 5-year renewable term, for example, or annually, known as the annually renewable term. As with the original term policy, the death benefit remains level. However, the premium will increase at every renewal based on the insured's age, and then will remain the same for the duration of that policy period. And again, with renewals, the insured does not have to provide insurability, regardless of their health. Insurers typically will set the limit to the number of times a policy can be renewed, or specify the age beyond which it can no longer be renewed. The convertible feature in term insurance policies allows the policy owner to convert coverage to permanent insurance that will start accruing cash value and will last until the insured's age 100. As with the renewal option, the insured does not have to provide insurability when converting the existing term policy to permanent. Now, let's focus on permanent life insurance. The two main differences between term life and permanent life is that permanent life policies build cash value and provide coverages for the entire life of the insured. Keep that in mind as we discuss different types of permanent life insurance. The most common type of permanent insurance is whole life insurance. So let's start with that. Understanding the key features of whole life insurance will help you build the foundation for all permanent policies. The key features you need to know for your exam are: level premium. The premium in whole life policies is based on the insured's issue age, so it does not change for the entire policy period. Death benefit is guaranteed and also remains level. Cash value. Whole life policies build cash value, which is scheduled to equal the face amount when the insured reaches age 100. So if the insured actually lives to age 100, the cash value will be paid out to the policy owner, and the policy matures. And finally, living benefits, meaning the policy owner has access to policy proceeds while still living, such as taking out a loan from the cash value, or taking an early payment of some of the face amount to pay for necessary medical expenses. Let's look at the three basic forms of whole life insurance: single premium, limited pay whole life, and straight life. And you can probably already guess how each one is funded. Single premium whole life is fully paid for after the one-time lump sum premium. There are no more premiums to pay after that. The policy generates immediate cash value, and because it's a whole life policy, it covers the insured until their death or age 100. Limited pay whole life allows the policy owner to pay the policy up well before age 100. That could be expressed in the number of years. For example, 20 pay whole life, meaning the policy will be paid up in 20 years. Or up to a specific age, such as limited pay to age 65. Why would somebody want to choose a limited payment? Well, think about it. It's a whole life policy, so it's going to cover the insured all the way up to age 100. If the insured retires at age 65, which is pretty typical, they'll probably be on a fixed income after that. So, if the life policy is paid up by that time, the insured no longer has to worry about paying the premiums, but they are still covered for the rest of their life. And then there is a straight life option, also called ordinary life or continuous premium whole life. Key word is continuous. In this type of policy, the policy owner continues to pay the premium every year until the insured's age 100 or death, whichever happens first. Of the three types of whole life policies, straight life has the lowest annual premium. There are some types of permanent insurance that allow the policy owner to pay more or less than the planned premium throughout the life of the policy. They are called flexible premium policies, and adjustable life is one of them. It was developed to provide the policy owner with the best of both worlds, term and permanent insurance. And in fact, adjustable life policies can be either term or permanent, so that's flexible right there.